All right, it's time now for top picks, and our first one is Abbott Laboratories, which of course is a maker of medical devices, ABT, on the New York Stock Exchange. Brianne, why are you enthusiastic about this name?
Yeah, why I really like Abbott is the medical device and healthcare company. That sector is typically and does typically hold up well in recessionary periods. So even with the price pullback, by 25% this year, it still has averaged 9% annually over the last 3 years and 16% annually over the last 5. I do expect growth to continue longer term as their revenue and earnings growth has been consistent with the company and does enjoy, excellent profit margins. So fundamentally, it scored a perfect 10 out of 10 for us. And as a giant in the healthcare industry with a diverse business model, it generates over $1 billion in revenue. So Abbott pays a 1.7 dividend, which is in line with the S&P 500, but also increases dividend over the past 50 years in a row.
Of course, Abbott has a COVID-19 testing segment, and I was looking at its most recent quarterly earnings where it said that it expects COVID-19 testing, that business, to remain strong. I'm curious what your take is on that, given where we're at in the pandemic and also just the ubiquity of tests these days. You can find them everywhere for free.
Yeah, yeah, exactly. Right. I think, we are still seeing a rise in cases, and as certain countries, depending on where your weather is, right? Like we're even in Canada, we're coming into winter and North America winter season, rising in flu, all kids are sick right now. I feel like, poor parents that are going through all of that. But the hospitals are overwhelmed. So I do think people don't put off priorities for health. So it will still do well, no matter what in a recession. People will prioritize healthcare. So whether it's COVID, flu, no matter what it is, people get help for it. So that's why I still like Abbott and I like the stock. Okay,
next up is BMO. Bank of Montreal, BMO on the Toronto Stock Exchange. You kind of teased this one a little bit earlier where we were talking about Scotiabank, and you said this, I believe you said that Scotia was your least favorite of the major Canadian banks. Why is the Bank of Montreal your number one bank pick?
Yeah, so BMO is in my top 3 for Canadian banks.
Okay, not necessarily number one, but top 3. Okay,
there you go. So the Canadian bank, or BMO, raised its dividend by 3% and now yields 4.6%. So again, great dividend company. Current price target on the street is around that 145 a share. So potential upside of 15% plus the dividend. BMO's commercial customers are holding up well in the lending segment. And the CEO of the bank said that the demand drops slightly as the economy weakens, but as the economy enters into a recessionary period, BMO is in a strong position. It had a strong loan growth in 2022. The bank acquired more clients and benefited from a large increase in its business. Investors and really us, I expect really BMO's asset-based lending in the auto dealer market to also remain strong, and the Canadian bank group as a whole faces headwinds, though, as elevated, consumer leverage and stretching housing affordabilities. That is something that we're watching. However, BMO, on the other hand, has the least exposure to the Canadian consumer and Canadian residential mortgages. So that's why I also think it's a great company, and I think it will do well over the next 12 months.
Broadly with the banks, though, how concerned are you about bad loans? We saw in the most recent quarter, virtually all of the banks set aside, hundreds of millions of dollars more to cover provisions for loan losses, as they use their own jargon.
Yeah, so, loan loss provisions is something that we had been researching and looking up a lot about the Canadian banks. Again, why I think BMO is, with their balance sheet and cash flow that they do have, even Royal and TD, those 3 as well. They had been packaging up a bunch of their bad debt and selling it off ahead of this. And, as interest rates continue to rise, yes, the banks are feeling it a little bit, but they are still collecting income from Canadians and from consumers as, people's mortgages are going up. So I think, yes, they might feel a little bit of tightening on certain things, but I still think over the long run, financials are a great sector in Canadian banks, and BMO specifically is a stock that I continue to hold.
Okay, and finally, we have Canadian Natural Resources. We only have a minute left for this. Keep those comments succinct, but why do you like it?
CNQ. Okay, there you go. I think, one of the largest oil and gas companies, geopolitical dynamics sparks as, we're seeing this shift in this hydrocarbon energy space. And I think, we feel now is the time to consider the best natural gas stocks to be buying. And CNQ is that for us. The stock has climbed 48% since the beginning of the year, but we still see it has room to grow. So price target is around 93, which is another still 25% upside from here, plus the dividend, healthy dividend of 4.5%. The company enjoys a good balance sheet and solid profit margin. So for us is why we still like CNQ.